In the days since J.P. Morgan CEO, Jamie Dimon declared the U.S. regional banking crisis to be over, after the failure of Silicon Valley Bank, Signature Bank, Credit Suisse, and First Republic, analysts, politicians, and the public are left wondering the extent of the damage. How did four seemingly healthy banks fail in such a short time? What does their collapse mean for the millions of Americans who buy into their products? Through a deep dive into the regulations, policies, and profits in the American banking sector, it is now possible to draw a more complete picture of a crisis born from deregulation, liquidity shortages, and bad actors. Since the financial crisis of 2008, the regulations of the U.S. banking sector have been loosened by President Trump. The reforms of the Dodd-Frank Act raised the minimum threshold for banks required to take part in the stress tests, removing oversight from banks with less than $250 billion in assets, the same group of banks that now finds itself in deep trouble. The reform also removed the Volcker rule that separated a bank's consumer operations and risky trading activities, allowing for riskier investments. The impact of deregulation has been felt most by those holding a total of $1 trillion worth of deposits, who sought to park their cash with larger, more secure banks in the wake of the first Silicon Valley Bank collapse. With fewer deposits, banks have struggled to manage liquidity, leaving them unable to repay customers when they demand funds. The U.S. economy relies most heavily upon these small to mid-sized banks, who account for nearly half of consumer and business lending, 45% of consumer lending, and 80% of commercial real estate loans. Customers who have placed their trust in banks like Comerica, Zions, Trust Financial, and KeyCorp have the right to ask why the authorities have failed to protect their depositors, and why their money was exposed to risky investments in long-term bonds they cannot access. The looming recession, higher for longer interest rates, and questions over the enforcement of regulations leave many asking if this really is the end of the crisis, or if there are lingering risks still exposed. Many, in fact, are calling for the reinstatement of the Dodd-Frank Act and post-2008 regulations, a call repeatedly refused by the Republican-controlled House of Representatives. With billions of dollars of deposits and investments on the line, citizens are now left wondering if Jamie Dimon's assurance of an extraordinarily sound U.S. banking system is one that can be trusted, or if government negligence has set the stage for yet another crippling financial crisis.